Okay, guys, so welcome to tonight's lesson. We'll be covering FAC 4861, FAC 4863. It is preparation for test 2. Um, what you should know, test 2 from a CTA 2 point of view covers change forex, foreign exchange, change in foreign currencies, whatever it's called, um, financial instruments, and share-based payments. From a CTA 1 point of view, you will only cover financial instruments. So therefore, we will focus on financial instruments today, and then we'll cover some share-based payments tomorrow. Changes in foreign currency will come through throughout the paper here and there, so we will just cover it as we go along. What's important to know that for CTA 2 guys, that financial instruments makes up about 20 to 25 marks. And what's the other one now? Share-based payments will make up around between 10 and 15 marks. Okay, and then about 5 marks for foreign currency. For CTA 1 guys, financial instruments is the only topic, so there will be a 40 marker just on financial instruments. So it's important that you understand it is important that you understand financial instruments, you know financial instruments. There are different aspects relating to financial instruments that you need to know. When it comes to share-based payments for the CTA 2 guys, you must be able to handle a share-based payment, whether it is an equity-settled share-based payment, whether it is a cash-settled share-based payment. Remember, for an equity-settled share-based payment, there are 2 circumstances. You need to know both circumstances. For cash-settled, there's basically 1. Then, in share-based payments, there's 3 further complications. Out of the 3, in no particular order, but number 1 is a group situation where a group entity, so for example, let me put it to you this way. So if you look at one of the financial services companies here in Cape Town, well, they're a listed company with the head office in Cape Town, Signia. You have Signia Limited, which is the JSE listed company. Then you have Signia Limited's subsidiaries, which there's a number of subsidiaries. Let's just use 2 of them, Signia Life and Signia Asset Management. So those are their 2 subsidiaries. Signia Limited, which is the listed company, is merely a holding company with all of its subsidiaries. It does not really have employees because it's not an operating entity. The operating entities are its subsidiaries, which is Signia Life and Signia Asset Management with a few others. So they would have employees in Signia Life. They would have employees in Signia Asset Management. Now, some of these employees, part of their remuneration package involves shares of the listed company. So what you see that an employee in Signia Life is not getting Signia Life shares, they are getting shares of Signia Limited. Similarly, you will have Signia Asset Management, which is a subsidiary. The employees over there is not getting Signia Asset Management company shares, but rather getting shares of the listed company, which is Signia Limited. So that results in a group situation. So where one entity is getting shares of another entity. So for a CTA 2 student, you must be able to handle such a situation as well. You'll have to know how to account a share-based payment in the entity receiving the goods or services, and then also know how to deal with the share-based payment based on the entity settling the share-based payment. So the entity settling the share-based payment is most likely Signia Limited, the listed entity. But the company receiving the goods or services is Signia Life, the subsidiary, or Signia Asset Management, the other subsidiary. How do you know they are receiving the services? Because it is their employees that's getting the shares. So the service that they are receiving is the employees service. Okay, so just keep that in mind. So understand as a for a CTA2 student, you need to know that. Then there's another two that you need to know. Basically, it is one thing with two different outcomes. So that is, there can be a share-based payment transaction where one of the parties have a choice whether they want whether the share-based payment transaction will be settled in cash or in equity instruments. Now that choice, the accounting treatment depends on who has the choice. Is it the counterparty that can decide, or is it the entity itself, the company itself, that can decide? So on a high level, there's basically 5 circumstances that can take place. And under each of those, there are different transactions that can take place. So for example, under equity instruments, you may have a modification or no modification. Under the equity instruments, there may be a vesting condition or no vesting condition, and so forth. But on a high level, there are 5 circumstances that can take place: equity instruments, an equity settled transaction, a cash settled transaction, a group related situation, a, um, a cash alternative where the entity have the choice, a cash alternative where the counterparty has the choice. So those are the 5 broad principles that you need to know, and there's obviously different details for each of those. So like I said, under the equity settled transaction, there are 2 circumstances: whether you can measure, whether you can estimate the fair value of the goods received reliably or not. If you can, there's a certain way you will transact. If you can't, there's a certain way you will account for the transaction. Similarly, for the equity settled, as well as for cash settled, are there any vesting conditions? Yes or no? If there is, how do you treat it? If it isn't, how do you treat it? And also modifications. So just take a note for share-based payments, we will cover that in more detail tomorrow. Just a quick high level, what you need to expect when it comes to share-based payments. For foreign exchange, this is a CTA2 question as well. The big thing on foreign exchange is simply going to be you are transacting, the transaction is in a currency other than the functional currency. So for example, for a South African company, the functional currency would be ZAR, South African rands. So if you receive money or you make a payment in a currency other than ZAR, then that will be considered a foreign currency. So the question would be, how do you translate into the South African ZAR? You would have to, so that is basically the treatments over there, and you need to distinguish between whether you have a monetary item or whether you have a non-monetary item. A non-monetary item, you just translate at the date of transaction, whereas for a monetary item, you translate at the date of transaction as well as at subsequent reporting dates, and then finally on settlement date. So those are things you need to consider with a fair value gain or loss going through profit or loss. Okay, so just be aware of that. But we will cover Forex as we go through this question. Now we're going to go into financial instruments. I'm going to do a high level overview on financial instruments. We're not going to go into detail because we had those free lessons that you can just watch for the details on financial instruments. But it's just basically giving a high level overview of the various topics when it comes to, or the various issues within financial instruments. And then we're going to dive straight into a question. Like I said, if you want a more detailed explanation on financial instruments, you simply just have to watch the that free master classes we had on financial instruments. So remember, when it comes to financial instruments, what you need to understand, what makes a transaction financial instruments? How do we classify a transaction or an item as a financial instrument? Basically, a transaction will be a financial instrument if one party have a financial asset and the other party either have a financial liability or an equity instrument. So On both sides, there has to be financial instruments. Okay, so one you have a financial asset, and the other one has a financial liability or a financial or an equity instrument. If that is the case, then you fall into the ambit of financial instruments. Financial instruments is governed by IFRS 9, IFRS 7, and IAS 32. IAS 32 deals with the classification of financial instruments. IFRS 7 deals with disclosure of financial instruments. It's like very, very big in the real world. And then IFRS 9 deals with the recognition and measurement of, so recognition and measurement of financial instruments. Okay, so just take note of that. And with measurement comes impairment, with measurement comes reclassifications and classifications and so forth. Okay, so remember IAS 32 deals with classification in terms of whether it is a financial asset, a financial liability, or an equity instrument. That type of classification does IAS 32 deal with. The classification that IFRS 9 deals with is it is a financial asset already, it is a financial liability. But what type of a financial asset would it be? What type of financial liability would it be? So that is the difference between classifications in terms of IFRS 9 versus IAS 32. Our big focus is going to be on IFRS 9. Okay, so just take note of that. Remember, we said a financial instrument definition means that one party has a financial asset, the other party has a financial liability or an equity instrument. So you need to know what makes something a financial asset. You need to know what makes something a financial liability or an equity instrument. Okay, so you can go read your IFRSs, and you can just watch it as videos, and that should help you. So just give you an example. When you go to, let's say you go to Woolworths, or you go to Truworths or Foschini, and you purchase a transaction using the store card. Okay, so let's say you buy an item of clothing and you transact with the retailer. The retailer is going to go debit trade receivables, credit revenue. Okay, because they sold inventory. They made a sale. And then they'll record cost of sales, debit cost of sales, credit inventory. Wow, why are we crediting inventory? Because inventory is leaving the store, inventory is decreasing. Inventory is an asset, so an asset decreases. An asset decreases on the credit side. For every credit, there must be a debit. The debit that relates to inventory, the debit that goes hand in hand with inventory is generally going to be cost of sales. And it makes sense to use cost of sales because you're making a sale. For the first part of the transaction, we're saying debit trade receivables. Why? We sold an item to a customer. The customer owes us money, so trade receivables increases. Trade receivables is an asset, so therefore assets are increasing. Assets increases on the debit side. So we say debit trade receivables, and we credit the sale, or we credit revenue. Why does it make sense that we credit revenue? Sales is increasing, so revenue is increasing. Revenue is income, so therefore income is increasing. An increase in income increases profit or loss. An increase in profit or loss increases equity. Equity increases on the credit side. Okay, so therefore the journal entry makes sense. Now, if you want to classify these items, we say credit inventory. Inventory is an asset. You have an accounting standard called inventory, so we will use IAS 2 for the inventory section. Cost of sales is an expense. Cost of sales is also covered within the inventory standard IAS 2. On the first transaction, we credited revenue. There's a specific standard on revenue, IFRS 15. Then we're going to have trade receivables. There's no specific standard that calls himself trade receivables. So the question is, in which standard does trade receivables fall into? We don't see any standard called trade receivable. We have a standard called inventory. We have a standard called revenue, but we don't have a standard called trade receivables. So which standard does trade receivables fall into? So this is the test. We know it's an asset. We know trade receivables is an asset. Why? In future, we're going to receive money. So there's a future economic benefit. And if we go through the asset definition, it will meet the asset definition. If we go through the recognition criteria, it will meet the recognition criteria. So we have an asset. The question is, what type of an asset is it? So one of the simplest ways to go through it is to run through your mind all the asset standards within the green books, within the SAICA handbooks, within IFRS. So I will just make mention of the asset handbooks, of the asset standards that we have covered and we will be covering. I'll cover on a CTA 2 level, not all of it will be covered in CTA 1. So basically the asset standards that we will come across up until the end of CTA would be IAS 16 PPE, would be IAS 2 inventories, would be IAS 38 intangibles, would be IAS 40 in investment properties. It would be what was it now? A right of use asset in terms of a right of use asset or a leased asset, specifically right of use asset in terms of IFRS 16. And then we have a financial asset in terms of IFRS 9. So the question would be, which one does trade receivables fall into? You'll have to go through each standard and you have to read the definition of what makes something inventory, what makes something PPE, what makes something intangibles, what makes something investment property, what makes something a right of use asset or a leased asset, what makes something a financial asset. What you'd come to learn that a financial asset is where, so a financial asset has to be a financial instrument. If, one of the definitions of financial asset is that the entity has a right to receive cash, okay? And remember, for something to be a financial asset, it must be a financial instrument. So in this transaction, Woolworths have a right to receive cash from the customer. So from Woolworths side, they have a right to receive cash. From the customer side, they have an obligation to pay cash. So the customer has a financial liability because they have to pay cash. Woolworths, the retailer, the company, the entity has a financial asset because they have a right to receive cash. So therefore, trade receivables falls within the standard of IFRS 9 because it meets a financial asset definition. So just take note, the same story came through in one of the tests. There's no standard called prepaid expense. We all know prepaid expense is an asset. But what type of an asset is it? There's no standard called prepaid expenses. So you need to fit into one of the standards. So you'd have to figure out which definition does it meet, and then you'll classify it as that type of an asset. So just take note, that is why trade receivables is a financial asset, because it meets the definition of a financial asset. Okay. So let's take it further now. So now we're going to deal with the recognition and the measurement of a financial asset and a financial liability. We're just going to do it high level quick, because the details you will learn in that free masterclasses. If you go onto our YouTube channel, Eduons, if you go to YouTube and you search Eduons, you will find it over there. Okay. So when it comes to a financial asset, or for that matter, whether it is, so this applies to financial assets as well as financial liabilities. But the thinking process applies to all assets and all liabilities. You have initial recognition, you have subsequent measurement, and you have derecognition. Okay. So for derecognition, if you read IFRS 9 derecognition, it's the longest part of the standard. Derecognition is the longest part of IFRS 9. But we are not required to know that hectic things. When you become a specialist, or when you're gonna when you're going to be focused in that areas, then you obviously have to know IFRS 9 in its entirety and not limited to what SAICA wants you to know for the ITC. But for our purposes, we are focusing on what you need to know for your SAICA exams. So the basic part of our derecognition is simply when you sell an asset. It's more complex than that, but the simple one is when you just get rid of the liability, when you get rid of the financial asset, that is derecognition. Okay, so that's parked, that's done. Now we look at initial recognition. Generally, there are two things we look at initial recognition: when to recognize and at what amount. Okay, but there's a third thing when it comes to financial assets and financial liabilities, more specifically financial assets. You have to classify the financial asset at initial recognition. So when do you recognize? The date you recognize is when the parties basically become party to the provisions of the contract. Okay, so they have a right to receive cash, or they have a right, or they have an obligation to pay. So whenever the provisions come into play, that is the date when you will recognize the financial asset or the financial liability. The amount at which you recognize is at fair value, not the amount you pay, not the amount you receive. You recognize, you measure at initial recognition the financial asset or the financial liability at fair value. In most cases, it's going to equal the bank amount and the fair value will be the same. But in some cases, it will not be. When it's not the same, you will just have a day one gain loss, or a day one gain, or a day one loss, or a day one gain. Okay, so just take note of that. So remember, you're always measuring at fair value at initial recognition. The third thing is to classify the financial asset, to classify the financial liability. If we go into financial liabilities, a financial liability will always be classified using the as at amortized cost, using the effective interest rate method. So financial liability will be classified always at amortized cost using the effective interest rate method, unless what? Unless you decide and designate the financial liability to be at fair value through profit or loss. But if you don't do that designation, then it will automatically be at amortized cost using the effective interest rate method. For a financial asset could either be at classified at amortized costs, or it could be classified at fair value through OCI, or it could be classified at fair value through P&L. The classification is based on the business model. Okay, so what is the business model in which the company manage the financial asset, and then also the cash flow characteristics. So the classification of a financial asset is based on two things: the business model in which the entity manages the financial asset, and the cash flow characteristics. If the business model is to collect contractual cash flows, and the contractual cash flows is solely payments of principal and interest, then it is amortized cost. If it is not solely payments of principal and interest, it will not be at amortized cost. Okay, so just take note of that. That means it will automatically be fair value. The question now is whether it is fair value OCI or whether it's fair value through P&L. Fair value through OCI can only be in one of two cases. It can either be mandatorily at fair value through OCI, or voluntarily through an election to be at fair value through OCI. So mandatorily at fair value through OCI is when you have a loan, is whether you have a loan or receivable in which the business model is to collect contractual cash flows, and the contractual cash flows are payments of principal, interest, and the reselling of the asset. In that case, it is mandatorily classified at fair value through OCI. It cannot be fair value through P&L. Why not? it cannot be at amortized cost. Why not? Because it is not solely payments of principal and interest. The voluntary one is where you have an investment in an equity instrument. You have investment in shares, and the entity irrevocably elects for it to be at fair value through OCI. If it does not elect for it to be at fair value through OCI, it will be fair value through P&L. Everything else will be fair value through P&L. And remember, any financial asset held for trading will be at fair value through P&L. So just take note of that. Just on the initial measurement, we said it's at fair value. But remember, the fair value can be impacted by transaction costs. Transaction costs, if it is fair value through OCI or amortized costs, you will add the transaction costs for a financial asset. If it is fair value through P&L, you do not add the transaction costs, you expense the transaction costs immediately. For financial liability, you will deduct transaction costs. If you're using the amortized cost method, if you classify it amortized cost using the effective interest rate method. So just take note of that. Now we come to subsequent measurement. Under subsequent measurement is based upon depends upon how you classified the financial asset or the financial liability at initial recognition. Okay. Remember, if it is at fair value through P&L, there will just be a fair value gain through P&L. If it is fair value through OCI, there will just be a fair value gain through OCI. If it is at amortized cost, then there will be an interest income. You'll have interest income. So basically, you will say debit bank for the payment that you receive, and the payment is for two things: to change the financial asset and to recognize interest income. Just take note, this was something I picked up with many students. When you read a question, try to identify who are you, which side are you dealing with? Are you dealing with the financial asset side, or are you dealing with the financial liability side? So just take note of that. Okay? You might just be able to pick up which side are you dealing with. And remember, for the financial asset that is classified mandatorily at fair value through OCI, it will have two components. It will have an amortized cost component as well as a fair value through OCI component. We dealt with that in the question, so you can have a look at it in that free masterclass that we went through. Lastly, we want to deal with with impairment or credit losses. Remember, there are basically three levels, but we are focused on just two of them: the general approach or the simplified approach. You have a credit impaired approach, which we don't deal with. The only thing that will attract credit losses are financial assets. The only financial assets that will attract credit losses is a financial asset that is classified at amortized cost, a financial asset that is classified mandatorily at fair value through OCI. At initial recognition, you will recognize a credit loss, and then at every subsequent reporting date. We will use the 12-month expected credit loss if there is not a significant, if there's no significant change in the credit profile of the counterparty. However, if there is a significant change in the credit risk profile of the counterparty, and it went from low to high, then you must use the lifetime expected credit loss. So just take note of that. Okay, so that is basically a high-level overview. The last one we're going to talk about is reclassification. Remember, once you classify a financial asset at initial recognition, you cannot change it unless the business model changes. So if the business model change, then you will do a reclassification. Remember, a reclassification can take place during a financial year. So let's say our financial year runs 1 January to 31 December. If a reclassification takes place on, if the business model takes place, changes on 30th September 2020, you only perform the reclassification on the reclassification date. The reclassification date is defined as the first day of the new financial period. So remember, our financial period done 1 Jan to 31 December. The business model changed on 30th September 2020. We will not change it on 30th September 2020, but rather we will change it on the reclassification date, which is 1 January 2021, the first day of the new financial year. So just take note of that. So therefore, at 31 December 2020, you still account for the financial asset based on its original classification, because the new classification only takes effect on 1 January 2021. So just be aware of that. Okay. So that is high level overview on financial instruments. We're now going to go into the scenario. We're going to do part one. Tomorrow we're going to do part two. Part two also has some financial instruments, but I'm going to do part one, which covers financial instruments, very little of share-based payments. So for the CTA2 guys, I'll bring in some extra share-based payments, not in this class, but in tomorrow's class. And then number three, it will have some Forex, foreign exchange transactions. Okay. If you guys can open up the scenario, open up the template I sent you, we're going to go to page, I think it's page 90. I think it's, let me just check quickly. I think it's page 90. While you open up and you go to page 90, I just have two things to ask. Number one, can those who are in CTA1 just tell me, just put in a chat, just tell me, or put a thumbs up or something that you are CTA1. I just want to get an indication who is CTA1. And then secondly, if you have any questions, you can ask me. So page 90, it is Satoshi. Okay, so that is the question we're going to cover. We're gonna do part one. So once you open it, if I can ask you to read part one, it is only one page, I think, or 2 pages. Okay, no, it's actually 2.5 pages. So I'm going to give you 10 minutes to read it. It is 2 pages, and then we will start going through the scenario. I'll read it with you afterwards. Can I just get the indication who is in CTA1? Anyone in CTA1 who's doing FAC4861? Let me know. Okay, but in the meantime, can you open up your TUT letter that I sent you? It is on page 90, Satoshi. Please read the scenario, just part one. I'm going to give you 10 minutes, and then I will read it with you after 10 minutes. While we're at it, the reason why I had a delay, I was waiting to see whether Eid is tomorrow or on Friday. There was a delay in the moon sighting. So Eid is not tomorrow. Eid is on Friday. So we're having no classes on Friday, but we will run classes tomorrow evening, same time. So then by Thursday, basically, by Thursday, we'll be done in terms of MAC and FAC1, FAC3. Then on Saturday and on Sunday morning, we will deal with FAC2, FAC4. Okay. So I'm going to give you 10 minutes to read. I'll chat with you guys again after 10 minutes. Once you're done reading, you can just give me a thumbs up. That will also give me an indication. But otherwise, we'll start with the latest at 10 minutes later, which was 25 past. Okay. Okay, guys, I'm going to share my screen now and we're going to read the scenario together. So let's quickly get into it. Okay. So let's read this. So it says Satoshi Ltd is a South African company listed on the JSE and has a 31 December year end. Satoshi sells rock drilling machines that are used in quarries and open pit mines throughout South Africa. So remember, they sell that. So whenever they make such a sale, it is revenue, and any of those items on their balance sheet would be inventory. Any of those items in their storeroom would be inventory. Okay, so that's what we know. After a successful exhibition at the Electra Mining Africa show during 2017, Satoshi received various queries from companies operating in Botswana relating to the rock drilling machines. Satoshi imports machines that can withstand extreme temperatures from South Korea. The profit before tax for the year ended 31 December 2017 is 32,560,000 Rand before processing the necessary journals to account for the transactions below. The balance of share capital and retained earnings at 1 January 2017 is 243,678 million Rand and 56,780,000 Rand respectively. Okay, so now we know, just kind of some kind of background. So we know we're most likely dealing with the 1 January to 31 December 2017 financial year end. Okay, so just take note of that. So they're telling you that Satoshi early adopted IFRS 9 financial instruments, IFRS 15 revenue contract with customers, and IFRS 16 leases. So we know rock drilling machines, any rock drilling machine that they buy. So remember what they do? They buy it from overseas and then they sell it over here. Okay. So by them buying rock drilling machines, which is items that they sell in the ordinary course of business, it means rock drilling machines is inventory. Okay. So just take note of that. In order to ensure that Satoshi will be able to meet the increased demand of the rock drilling machines that can withstand extreme temperatures, Satoshi decided on 1 September 2017 to import 3 rock drilling machines at a cost of 204 million K, whatever that is, South Korean won. Okay. The official currency of South Korea is South Korean won. The machines were delivered to Satoshi on 1 October 2017. Control of the machines passed to Satoshi on delivery date. So what's important, we placed an order. Okay, so we obviously placed an order on 1 September 2017. I don't know how many, I'm not sure how, I don't know how many machines, or 3. So we place an order for 3 machines. Okay. Each machine costs 204 million wons. And so therefore, what we're going to do, we imported from Korea, it's coming to South Africa. Once we receive it, we must say debit inventory, credit payable, or credit bank, depending whether we're paying immediately or whether we're paying at a later date. Okay. What's important to understand that the question is, when do we recognize? We recognize when we gain control. When do we gain control? When the risk and rewards of ownership transfer from the seller to us. So they're telling us that control passed on delivery date. When did we get delivery? On 1 October 2017. So therefore, on 1 October 2017, we're going to say debit inventory, credit payable or credit bank. Now, this amount is in foreign currency, so we need to translate it at the date of transaction, at the date of initial recognition, at the date of control. We need to recognize revenue and we have to translate it using the spot rate at that date. Okay, so just take note of that. So we're going to say debit inventory, credit payable. Because I'm saying the foreign creditor was payable as follows. 1 December, we're paying for 2 machines, and on 1 February 2018, we're paying for 1 machine. What's important to understand that, so therefore, on 1 October 2017, we're going to say debit inventory, credit, creditors or credit trade payables for 204 times 3 times the spot rate at 1 October 2017. Then on 1 December 2017, before the end of the financial year, we will pay for 2. So what happens with the liability? We have to remeasure the liability, and any forex gain or loss will go through profit or loss. And then we settle the liability on 1 December 2017. However, the third machine will only be paid, and remember, we don't change the inventory balance. Inventory is a non-monetary item, so therefore it stays at its price at the date of control. At initial recognition, it stays its price. It is only a trade payable, which is a monetary item, that will be remeasured at every subsequent financial year end, as well as at settlement date. Then we have an amount that will be payable in the next financial year. So therefore, at 31 December 2017, the end of the current financial year, that liability will still be outstanding. As a result, we're going to have to remeasure it to the closing rate at 31 December 2017, and any gain or loss on that liability will go through profit or loss as a foreign exchange gain or loss. Okay, so just take note of that. Then they say the above repayment terms are normal credit terms. Okay, so we're happy. If it was beyond normal credit terms, we'd have to present value these numbers. So they're not making it that complex. They're just saying it's normal credit terms. So there's no need for any present valuing. Then they say on 1 October 2017, Satoshi entered into a 5-month forward exchange contract for the 204,000 payable on 1 February 2018 in order to hedge itself against foreign currency risk at a forward rate of whatever that is. Okay, 1 is equal to 1 cent. Satoshi does not apply hedge accounting in terms of IFRS 9 financial instruments. I don't think hedge accounting is anymore part of the syllabus, so we don't have to worry about hedge accounting. It's not part of the syllabus. I think it was before, but you hardly do it, hardly come across hedge accounting. I think many financial services companies use hedging, but many don't. Okay. So only for the one machine, they have taken out a FEC contract. So therefore, we will have to do a fair value gain or loss for the FEC or FEC gain or foreign exchange gain or loss as a result of the FEC at 31 December 2017 at year end. Nothing happens at initial recognition for an FEC contract or for any hedging instrument. And then they're giving us the applicable exchange rates. They're giving us an exchange rate on 1 September. So I might just take a note now. They're giving it 1 Rand equals how many KWRs? We want it other way around. Okay, so we will have to convert that in, or we will just see how we'll deal with that. Okay, so remember, must be very cognizant of how the exchange rate is presented. We always wanted 1 foreign currency equals how many ZARs, not 1 ZAR equals how many foreign currency. So we wanted 1 foreign currency equals how many ZAR. So The way we're going to deal with this, we're going to say that divided by the transaction price to get the correct exchange rate. Okay, so on 1 September 2017, that exchange rate is not applicable because nothing happened on 1 September. No accounting transaction took place on 1 September. On 1 October 2017, we are going to use that exchange rate because that is the date we gain control. So that is the date we have to translate the inventory at. Then on 1 December 2017, we will be using, sorry, on 1 October 2017, we will, 1 December 2017, we will be using that rate. Why? Because two of the, well, I'm going to use that one now. Because two of the machines were settled. So therefore, we're going to, we have to remeasure the liability at 1 December 2017. 31 December, we're also going to use that date. Why? Because one of the payables is still outstanding at that date. We will also make use of the forward exchange contract at that date because the FEC applies to that payable that is still outstanding at 31 December 2017. Then if we are required, then on 1 February 2018, we will also account for the transaction. So they're saying one of the machines was sold to a new Botswana client on 1 December 2017 for 2.5 million, and the other two machines were sold in March 2018. So 2018 is in the new financial year. We're not going to bother with that. But the one that is sold in the 2017 financial year, we will have to account for that. So remember, there's going to be two parts of the transaction. It is the sale as well as the cost of sales. So what you must go through your mind is the impact on profit or loss. Because remember the question above, in the scenario above, they gave us profit or loss, and they said this is profit or loss before taking into account any of these transactions. So what is going to impact profit or loss is simply going to be the remeasurement on the settlement date, the remeasurement on, the remeasurement on the settlement date on 1 December 2017, the remeasurement of the liability at year end, 31 December, as well as the FEC contract at 31 December 2017. So those are the three things. Then what will also impact profit or loss is going to be the sale of 2.5 as well as the cost of sales relating to the machine. How are we going to know what's the cost of sales? We're simply going to say that 204 times the exchange rate at the date when we recognized inventory on 1 October 2017. So just take note of that. Now we go to point number 2. Disposal of investment. Satoshi holds an investment in Nakamoto Ltd. in Nakamoto Ltd bonds with an amortized cost of 5.6 million on 31 December 2016. These bonds were held in a portfolio of investments that Satoshi manages in order to collect contractual cash flows of interest and principal. So therefore, it's correctly at amortized costs. The bonds have an effective interest rate of 10% per annum. Interest is payable annually, and the bonds are redeemable at par on 31 at par value on 31 December 2020. On 1 July 2017, Satoshi decided to sell the bonds for 5.9 million to finance capital expenditure. The bonds were never credit impaired and no credit losses were expected throughout the life of the financial asset. Okay, so what's important to take note? They held this bond with the objective to collect contractual cash flows, and the contractual cash flows were solely payments of principal and interest. So therefore, they correctly classified it at amortized costs. So although they sold these bonds before the redemption date of 31 December 2020, it does not mean it is no longer amortized costs. Okay, they decided to sell it, they have the right to sell it. They did not change the business model, and the business model was correctly classified at amortized costs So we will still treat this transaction at amortized cost. Don't think that if they subsequently sell the asset before redemption date, that is a change in classification. It is not a change in classification. Remember, you only have a change in classification. You only have a reclassification if there is a change in the business model. There's been no change in the business model. They simply just sold the shares for whatever reason. The reason was to fund capital expenditure. So therefore, it is still correctly accounted for as at amortized cost. Please be aware of that. Okay, so over here, what would happen? So on 1 July 2017, they sold the asset for 5,950,000 rand. So we're going to say debit bank 5,950,000 rand. Then we're going to have to credit the financial asset. We're going to have to credit the financial asset at amortized cost at 1 July 2017. So the way we're going to deal with that is we take the present value at 31 December 2016, which is that 5.6 million, and we work out 10% interest for 6 months. So whatever 10% interest is for 6 months, that is going to be the interest income we earned, and we will capitalize that to the asset. So the 5.6 plus 6 months of the 10% of the interest earned, that will be capitalized, and it will be our amortized cost at 1 July 2017. So we'll get rid of the asset at the amortized cost amount at 1 July 2017. Any difference between the amortized cost amount and the bank amount would be just basically a gain or loss on disposal. But when we do the question, you will see it. I'm not going to spend too much time on the share-based payments one, so I'm going to skip it because this is for CTA 2. For the CTA 2, guys, we will just come back to this aspect in tomorrow's lesson. Okay, so I'm going to skip it. So the last point, number 4, investment in debt instrument. On 1 January 2017, Satoshi acquired an investment in Reddit Ltd bonds at a fair value of 3 million rand. No transaction costs were paid. Okay, so they acquired at fair value. So therefore, it appears that the fair value and the payment is exactly the same. So therefore, there won't be any day one gain or loss. There was no transaction price. There was no transactions paid. So we will not have to deal with any transaction costs. They say the bond pay coupon interest of 400,000 Rand on 31 December of each year and will be redeemed on 31 December 2019 at a face value of 2.5 million Rand. Satoshi holds his bonds to collect contractual cash flows, and when an opportunity arises, it will sell the bonds to reinvest the cash in other financial assets at a higher return. So therefore, it is held in a business model to collect contractual cash flows. However, the contractual cash flows is basically payments of principal, interest, and the reselling of the asset. Therefore, it cannot be at amortized cost. It will be mandatorily classified at fair value through OCI. Therefore, both collecting contractual cash flows and selling the bonds are integral in achieving the business model objective. On 1 January 2017, the bonds were not credit impaired and no credit losses were expected. However, on 31 December 2017, the credit risk had increased significantly since initial recognition, but the bonds were not credit impaired. The fair value of the bonds on 31 December 2017 is 2.5 million Rand. So the financial manager of Satoshi provided you with the following schedule of assessed credit risk and estimated expected credit losses of its investment in Reddit bonds. Date 31 December 2017, They say the assessment risk is high, so therefore we can't use the 12-month expected credit loss. We're going to have to use the lifetime expected credit loss of 500,000 Rand. Okay, so just be aware of that. So now let's read the required, and then we will attempt it. So we will do part A and part B. We will deal with part C with part 2 tomorrow. So they say provide the journal entries to account for the investment in Nakamoto in the financial statements of Satoshi Ltd for the year ended 31 December 2017. Journal narrations are not required. Okay, so I'm going to open up Excel quickly. Then you might just tell me once you see Excel. I'll tell you when you should be able to see Excel. Okay, so you should be able to see you should be able to see Excel. You can just tell me if you don't. Okay, so let's do part A. So this is going to be part A. Okay, so for part A, they asked us for journal entries to account for the disposal of the investment in Nakamoto bonds. We know that it is at amortized cost, correctly classified at amortized cost. So we are in the financial year 1 January 2017 to 31 December 2017. If there was no disposal, the only transaction that would have taken place would have been on 31 December 2017, where Satoshi in their books would have recorded a journal entries going as follows: debit bank, credit interest income, credit, and then the balance going against the financial asset, amortized cost. Okay, that would have been the journal entry. However, they won't have that journal entry because they sold the bonds before 31 December 2017. They sold the bonds on 1 July 2017. So what they'll have to do, they will have to recognize interest income for the period 1 January 2017 to 30th June 2016. Why? Because they've earned interest during that period. And using amortized costs, you will get an amount at that date. Okay, so what's going to happen on 1 July 2017? On 1 July 2017, we have to recognize the interest income we have earned for the 6 months. So what we're going to do? We're going to say interest credit interest income P&L. It's going to be a, let's just do this quickly. We're going to have debit, credit. For every debit, there must be a credit. So here's a credit. So for every credit, there must be a debit. So it's going to go against financial assets. So when you take it against the financial asset, amortized costs. And the financial asset is an asset, so it's a balance sheet. A balance sheet we represent by SFP. So the workings would be as follows. How are we going to do the workings? So our workings, so for working one, it would be as follows. We must recognize interest income we must recognize interest income for the 6 months. The way you work out interest income is taking the present value, at the beginning of the year multiplied by the effective interest rate. Okay. But you would multiply it by 12 over 12 when it's a full year. But because it's not a full year, it's only 6 months, we'll multiply it by 6 over 12. The present value at the beginning of the year is the amortized cost amount at 31 December 2016. So remember, interest equals present value multiplied by I multiplied by time. Okay, so we want the interest amount. We're going to need the present value. We're going to need I. And we're going to need the time. So the time is 6 over 12. Okay, so it is 6 months out of 12 months. 6 divided by 12. I was given to us as 10%. The present value was given to us as 5.6 million. Remember, the amortized cost amount at 31 December 2016, that is the present value at the beginning of the year. So therefore, interest would just be the product of all of those. So it's going to equal present value at the beginning of the year, which is the amortized cost amount, multiplied by 10%, but that 10% is an annual rate. We only earn interest for 6 months, so therefore we multiply it by time. So we get to an amount. So the interest earned for the 6 months is 280. That's going to equal to 280. For every credit, there will be a debit. We will just tell them we got this number from working one. Now remember, the way you work out amortized cost. Okay, so amortized cost will basically be as follows. The present value plus interest for the period. So present value at the beginning of the period. So the present value at the beginning of the year plus interest for that period minus payment for that period. Okay, so minus payment for that period. So therefore, when you get rid of a financial asset at amortized cost, you must get rid of it at the amortized cost amount at that date. When you get rid of an asset that is measured at fair value, you get rid of it at its fair value at that date. So because we are getting rid of a financial asset at amortized cost, we need the amortized cost amount at 1 July 2017. So therefore, the amortized cost amount, the present value at the date of sale, will be as follows. Present value at the beginning of the year plus interest for the period less a payment for that period. And this will give us amortized cost at the date of sale. So this will be amortized cost at 1 July 2017. We know the amount is 5.6 million. 1, 2, 3. The interest that we earned for the period was only for 6 months. So it was equal to this 280. Okay. We'll tell them we got that from working one. Then the only payment we will receive in this period would be the payment at 31 December 2017. We're not going to reach that point. So the payment for the period is 0. So therefore we say present value plus interest minus the payment. So the amortized cost amount at 1 July 2017 is 5880. So now we need to do the next journal entry. The next journal entry is where we are selling the financial asset. Remember, it does not mean we are selling this financial asset at amortized cost before the redemption date, that there is a change in classification. The company has a right to sell it. There was no intention of changing the business model. So therefore, there's no reclassification. Okay, so just be aware of that. So we're selling the asset, so we're making money. So therefore, money is increasing. The account we take money to is called bank. Bank is an asset. An asset increases on the debit side. So we're going to say bank. The bank amount, bank is an asset, so it goes against SFP. The bank amount was given to us as 5950. 5959, oh, let me just see. Yeah, 5950, 123. Okay. Then we're getting rid of the financial asset. So the financial asset is decreasing. The financial asset is an asset, so asset is decreasing. Assets decrease on the credit side. So financial asset, amortized cost is decreasing. So we're going to credit financial assets at amortized cost. At which amount do we credit it? We credit it not at the bank amount. We credit it at the amortized cost amount. If it was a financial asset at fair value, you credit it at the fair value amount. Okay, so where did we get this? We're getting it from working 2. As you can see, the journal entry is not balancing. We are missing the difference between the two. We are missing 70,000 Rand. That 70,000 Rand will go to P&L. What do we call it? Gain on disposal. Okay, so it goes to other income effectively. What is this other income? Gain on disposal. So that is the journal entry. Okay, so the important thing to have picked up over here is a few important things, that you must still recognize interest income for the 6 months that you've earned it, irrespective of whether that payment transaction takes place. The second thing you need to know, that you don't get rid of the asset at the bank amount. You get rid of the asset at its amortized cost amount at the date of sale. How do you get it? Amortized cost is the balance at the beginning of the year, the present value at the beginning of the year, plus interest for the period minus payments for the period. And remember, any difference between the two is a gain or loss, and that gain or loss goes through profit or loss. So that is 5 marks. Any questions? Any questions? Okay, I'm assuming no. So now we go to part B. So now we go to part B. I'm going to read part B now. So let's read the scenario. Let's read part B, required. They say, calculate profit before tax in the financial statements of Satoshi for the year ended 31 December 2017. We know they gave us the profit before tax, and we know that they told us that the profit before tax is calculated before taking into account any of those transactions. There were 4 transactions. The import of the drilling machines. There was there was import of drilling machines. There was what was it now? There was the Namakoti. What was it? There was the import of the drilling machines. There was the disposal of the bonds, Nakamoti bonds. There's a share-based payment arrangement. So we will ignore the share-based payment arrangement for this transaction. I'll just mention it there, but I'm not going to put any numbers to it. We will deal with that tomorrow. And then there is an investment in the debt instrument. Okay, so we're going to start off with the profit before tax. So profit before tax, and this amount is given. Okay. Then we're going to deal with the we're going to deal with point number 1. Point number 1 is the rock drilling machines. Okay, so point number 1 is the rock drilling machines. So point number 1 is the rock drilling machines. So we will do that. Point number 2. Point number 2 is the disposal of the investment. Point number 3 is the share-based payment arrangement. I'm going to leave this, I'm going to put it in as a heading, but I'm going to leave it blank. We're not going to deal with it today. And then number 4 is the investment in debt instruments. So this will result in our adjusted profit before tax. Okay, so this would be our adjusted profit before tax. Okay, so that's what we're going to do. Now we will deal with all of these. So the first thing you can do is plug in the profit before tax that was given to us. So the profit before tax was given to us as 32,560 before processing the necessary journals to account for the transactions below. So how are you going to deal with this? When you read through the scenario, you must picture the journal entries. Then once you picture the journal entries, you must identify which line items of the journal entries impacts profit or loss, and then you bring that in to our calculation. So the starting point is the given profit before tax, 32,560. 32,560. 1, 2, 3. 1, 2, 3. No, just 32,560. Okay, so that is given. Now we can deal with each of these line items. Let's start off with the disposal of the investment. The disposal of investment, well, I will start off with that because we got it from part A. So it had 2 things. It had interest income, and it had gain on disposal. The interest income is an income of 280. So it increases profit or loss. So therefore we have it as positive. The gain was a gain, increases profit or loss. So therefore it is positive. Or we're going to say this was from A. Okay, so through that whole transaction, what we know, there was an interest income and there was a gain on disposal. So that's the only line items that impacts profit or loss. If you look at the journal entry over here, P&L, credit, a credit to P&L increases profit or loss. There's a P&L, a credit to P&L increases profit or loss. Okay, so there we have that. So part A, you're probably going to score 1 mark for those two, but you're just bringing it over. And you probably score 0 marks over here or half a mark for correctly starting off with the right number. Now the rest is going to be over here and the rest is going to be over here. What I'm going to put this, okay. Okay, so we're going to deal with this another time. I'll just make it red. So we're not going to bother with that. Okay. So with share-based payments, I'll deal with it tomorrow. I'm not going to deal with it today. So we're going to focus on the rock drilling and the rock drilling and the investment in debt instruments. Okay. So let's have a look. Let's start off with the rock drilling. So remember with the rock drilling, I told you to identify that we made a sale. And with that sale, it's a cost of sale. We only made one sale and there's a cost of sale relating to that one sale. Then we have some Forex adjustments. So we have a Forex adjustment on a settlement date. We have Forex adjustments translating at the year end. And we also have an FEC adjustment. Okay, so let's have a look how we're going to deal with these transactions. So the easiest thing we can start off with is the sale and the cost of sales. Okay. So the sale was given to us as 2.5 million. Sales increases profit or loss. So therefore we make it positive. Okay. The cost of sales, we sold one item. So we sold one item. So we sold one item. And this item cost 204 million won. But we need to bring it into rand value. The cost of sales will equal to the inventory amount. Okay, so remember we said debit inventory, credit payable. When the inventory is sold, we say credit inventory, debit cost of sales. So that's what we're doing over here. We are say crediting inventory and we're debiting cost of sales. The amount that you translated at must be what you recognize inventory at. We recognize inventory at the date of transaction. The date of transaction is when the risk and rewards of ownership transferred, when we gained control. We gained control on 1 October 2017. So therefore, we must use the exchange rate at 1 October 2017. And the exchange rate at 1 October 2017 was 1021. So we're going to say divide by 102. Remember, if this was one foreign currency equal an amount of ZAR, then we will multiply. But because the exchange rate is given indirectly, which is 1 rand for each foreign currency, we must divide. Okay, so therefore we're going to say, so remember cost of sales, an increase in cost of sales is an increase in an expense. An increase in an expense decreases profit or loss. So I'm going to say equal, I make it minus 204, 123, 123. We sold one machine. The cost of the machine is in foreign currency is 204. We don't want the foreign currency, we want the rand value. So we translate it into the functional currency, which is ZAR, at the transaction date exchange rate, which is 102. Okay, so there's the cost of sales. So we dealt with the sale, we dealt with the cost of sales. What do we have to deal with still? We have to deal with the changes in foreign currency. The change in foreign currency, remember there are three issues you have to deal with. Number one, you deal with the date of transaction. Number two, you deal with the translation of a monetary amount. You deal with the remeasurement of a monetary amount at year end if it was not yet settled. The third, you must deal with the translation of a monetary amount, of a monetary item at settlement date when you do settle. So remember, two out of the three machines were settled on 1 December 2017. So therefore, we will have a remeasurement transaction where we will change the liability, the payable, and we will adjust, and then we will recognize the forex gain or loss in P&L. And then the third machine is only settled next year. As a result, at year end, we will still have a payable outstanding. So we'll have to remeasure that payable at 31 December 2017. So we're going to deal with the forex adjustment relating to the settlement. Okay, relating to the settlement. What are we settling? We are settling two machines, which is equal to 408. So we're settling two machines, 204, 123, 123 times 2. Each machine costs 24. We're going to have to multiply this, multiplied by the change in exchange rate. Okay, so the exchange rate was 102. It is now at 1 December 2017, it is 95. So you can see the exchange rate reduced. Okay. So if you have a look over here, on 1 October 2017, for every 1 rand, we could get 102 ones. Now, at 1 December, we can only get 95 ones. So we're getting less ones for every rand. So that is a negative impact for us. So this will be a foreign exchange loss. Okay, so just think about it. We need to pay money out. Okay, so the more ones we must get, the negative it is. So over here, on 1 October, if we are to pay on 1 October 2017, on the date of transaction, we would need less rands. Why? Because we got 102 ones for every 1 rand. So the number of rands we're going to need to cover the transaction would be less. Now on 1 December 2017, when we are actually settling, we're going to need more rands, because for every 1 rand, we're only getting 95 South Korean won. So as a result, in order to settle this amount, we're going to need more rands. So that means it is a loss for us, because we're going to have to spend more money. So how are we going to deal with this? It is a loss, so we know it's going to be negative. Actually, we can just change it around. Let's just put 95. The latest exchange rate less the earliest exchange rate. That will help us. Okay, so this must be a negative. So it's going to equal to 204, 123, 123 times 2. We're taking 408 because we're settling two machines. Each machine costs 204. Okay, the foreign exchange adjustment would be, not multiply, divide by, would be 95 minus 102. So that is the foreign exchange adjustment. Are we happy with that? So let's check the number quickly. Okay. Oh no, this copy is too, this is too hectic, this amount.
Aren't we supposed to multiply it by 7 instead?
Multiplied by?
By the difference between 95 and 102.
Yeah, was multiply. No, it's still a bit too much. Something not right over here.
Don't you take the total amount on the, like you're only taking 204 million. Don't you take the 4 plus the 204, the total amount?
Why? I'll come to that just now. Now there's some, you can already see something not right because the sales is only 2.5 million. How can a fair value adjustment be in the billions? Something is not right over here. So if we just say 204, we say equal 20, if we guys, we just do a separate working. If we do the workings over here,
Aren't we supposed to convert the ones to ZAR?
I'm gonna do it now, yeah.
And then you divide.
204, and we're gonna say workings. We just do it the long way. Just do it the long way. Working 1. So I'm dealing with the 2 separately from the 1. There's different ways of doing it. You can do it with a 3 or the 2, whatever. I'm doing it with the 2. We're settling 2. So we're settling 2 drilling machines. Okay, so the drilling machines, 2 drilling machines, which is equal to 204, 123, 123 times 2. Okay, so it's 408. So this is on 1 October 2017. Exchange rate is 102. So therefore, the ZAR amount on 1 October, so ZAR would equal that divided by that. Okay, so that we would have said debit, inventory, credit, payable. So this journal entry on 1 October would be inventory, trade, payable. Debit, credit, SFP, SFP. So the journal entry would simply be debit inventory for the 4 million, which makes sense. We expect it to be 2 million rand each, and credit trade payable 4 million. Now we are settling it. So when we settle it on 1 December 2017, we are still going to do the exact same thing. We are still going to do the exact same thing. Only difference is now this must be 95. Okay, so that needs to be 95. So what we're going to do on this date, we don't change the inventory. All we're going to do, on 1 October, we owed the supplier 4 million. Now on 1 December, we owe the supplier that amount, that whatever that difference is. Okay, so therefore, what's happening? Trade payables is increasing. Trade payables is a liability. Trade payables is a liability. A liability increases on the credit side. So therefore, the difference, Forex adjustment, is equal to the last time minus the old time. So you can see the Forex adjustment is a loss. So the liability must increase by 294. And for every debit, there must be, for every credit, there must be a debit. The debit is going to be Forex loss, P and L, with that difference. So that is what the number needs to be. That makes a lot more sense, 294,737. Okay, just ignore that number, then how I did that calculation. So it's a loss, so we're going to say equal 294.
And now listen here,
Yeah.
why do you only take the 2 machines? No? But in the scenario, it says here,
There's 3 machines. Yeah, because the third machine,
all 3 machines.
the third machine I'm going to do
No, but
separately.
listen here, all the machines were delivered to Satoshi on 1 October 2017. That means include all 3. So don't you work out the currency for all 3 on 1 October 2017?
Yeah.
Because control of machines passed to Satoshi on delivery date.
Okay.
So don't.
We're going to come there now. You're going to see what I'm doing. So the way you're going to do it is correct. The way I'm going to do it also going to be correct. So I'm dealing with the profit or loss impact. Okay. So what I'm doing is I'm working out the Forex gain or loss. So there's, remember, Forex gain or loss happens on 2 instances, on settlement date and at every year end. Only 2 were settled in the current year. So therefore, I'm only working out the 2 relating to the settlement. 1 is settled next year. So therefore, that 1 is going to have a Forex adjustment at year end. So I'm only going to do that adjustment at year end. You're going to see how I'm going to do it at, it's going to be the same by applying 1 October. So we will get there now. So here we have this Forex exchange settlement year end. So here we can have the Forex settle adjustment year end. So we can do the same thing, same principle, working to, I'll just copy this over. So what's going to happen? So I'm dealing with the 1 drilling machine. I'm dealing with the 1 drilling machine. So we only need 1 over here. So we have 2 million. Okay. So multiply by 1. What's going to happen? That rate stays the same because we gain control on 1 October 2017. So that's the 102. But we never settled it in the current year. We're only settling it next year. So the way you will settle it next year, so because you're settling it next year, at year end, you have to remeasure the liability. Okay, so this journal entry over here will be the same. We're going to have the 2 million. that journal entry over here. We'll bring that journal entry now. So therefore, at 31 December, the exchange rate is, let's just see, at 31, let's just see what's the exchange rate. What was the exchange rate? So at 31 December, the exchange rate is 90. So I'm going to change this to 90. So there we make another loss. So we get the 266. Okay, so what does that mean? Over here in the fair value, I will just go and fetch the Forex gain or loss. So that is 4 out of the 5 things. The last thing we have to deal with now is the FEC contract. So now we have to deal with the FEC contract. That's the last thing we're going to have to deal with. So remember, because each of it was a loss, the liability increased. So the liability increased so a liability increase on the credit side. For every credit, there must be a debit. The debit implies it is a loss. So therefore, because both of it is a loss, it reduces profit to loss. So therefore, it is negative. Now we're going to deal with the FEC contract. Now we will deal with the FEC contract. Okay, so remember, only one transaction we're going to be dealing with. Only one transaction, only one machine has an FEC contract. So the way you will deal with that is by looking at the exchange rate, at year end versus what you will be paying when you settle the exchange, when you settle the forward exchange contract. So if you work out working 3, an FEC contract will be worked out as follows. So we have a look at the FEC contract at settlement date. So the FEC contract at settlement date. So so it's the item, which is 204, only one machine, 123, 123. The rate in the contract, FEC rate, they told us it is, let me just go read it quickly again. They told us, where did they tell us now? So they said, so just have a look at it. When they say in that paragraph, in the last paragraph on page 90, it says on 1 October 2017, Satoshi entered into a 5-month forward exchange contract for 204 million won, payable on 1 February 2018 in order to hedge against the foreign currency risk. The forward rate is 1 won equals 1 cents. Okay, so the forward rate, so here let's call it the forward rate is 0.01. We can multiply over here. Why can we multiply? Because the exchange rate is given 1 foreign currency equals some ZAR amount. It is not 1 ZAR equals foreign currency. So just take a note. So because it is given 1 foreign currency equals a ZAR amount, we can multiply. So on 1 February 2018, we are going to pay this amount. On 1 February 2018, we are going to pay the 2040. Okay, so no matter what happened, on 1 February 2018, we're going to pay 2040. Now we want to compare it with the forward rate at 31 December 2017. sorry. Now I want to compare it at 31 December 2017. So the item is still 204, but now the forward exchange rate that is given, so you must use the forward rate column. So you can see at 31 December, we have 85.1. So we're going to make this 85. But now remember, we can't multiply. We're going to have to divide, because in this one, it is 1 rand equals foreign currency. So we're going to have to divide. So if we didn't have the the forward exchange, we would have paid 2.4. We're going to pay 2040. If it wasn't for the foreign currency, if it wasn't for the FEC, sorry, we would pay 2.4. So therefore, the FEC is saving us. So therefore, it is a gain. So you can see with the forward exchange contract, we're going to pay 2,040,000 Rand. Without the FEC, if it wasn't for the FEC contract, we'd be paying 2.4 million right now. So therefore, the FEC contract is currently saving us. So the journal entry would just be a gain to FEC. So what we do over here, the difference so this, remember, this is a gain now. So the FEC contract, the FEC gain is equal to 360. So it's very important to understand. You have to look at the absolute numbers over here. Okay, so let's just quickly understand. If we have a look over here, if we had to settle on 1 October 2017, we would have paid 2 million. But currently, we are so this is not 1 December, this is 31 December. But we didn't settle on 1 October 2017. So if we are to settle on this date, we'd have to pay 2.26 million. So therefore, we would have to pay more if we were to settle on 31 December. Therefore, we will be paying more. As a result, the exchange rate is a loss. Over here, the FEC contract is saying that we're only going to be settling on 1 February. So we're only going to be settling on 1 February. And when we settle on 1 February, the total amount we're ultimately going to be paying is 2,040,000 Rand. If it wasn't for the FEC, we would have to pay 2.4 million. So the FEC is saving us. The FEC is saving us. How much is it saving us? 360,000 Rand. Because we were to pay 2.4, but we're actually going to pay 2040. Therefore, the FEC is saving us, and as a result, it is a gain. The gain is a difference of 360. So just make sure you understand what the foreign exchange differences are telling you. So you know what you need to do, how to impact profit or loss. Is it increasing profit or loss, or is it decreasing profit or loss? So that is all from the drilling machines. So the drilling machines had foreign currency. It had 3 types of foreign currency. It had foreign currency at initial recognition. It had foreign currency at settlement date, and it had foreign currency at year end. Then it also include an FEC, a forward exchange contract. Okay, so there were those 4 aspects. Then the drilling machine section also dealt with the sale of 1 drilling machine. With a sale comes cost of sales. So just be aware of that. Okay, so there we have, so that's everything under drilling. everything under disposal. We will cover the share-based payment tomorrow. So now we'll deal with the investment in debt instrument. So now we can go to point number 4. So for point number 4, where's point number 4 now? If you go to note number 4, so for note number 4, what we'll be dealing with is as follows. We know there's going to be an expected credit loss. We know there's going to be an expected credit loss. The expected credit loss is going to be the lifetime expected credit loss, which is going to be the 500,000 Rand. Okay, so that we can already plug in. That's the easy one. Expected credit loss. We're going to use the lifetime expected credit loss. Why? Because the credit risk is high. There was a significant increase that caused the credit risk to be high. And as a result, we use the lifetime expected credit loss. The expected credit loss is going to be 500,000 and not the 32,000, not the 12-month expected credit loss. If the expected credit loss was normal or low, then we will use the 12-month. But because it's high, we will use the lifetime. And expected credit loss reduces profit or loss. So therefore, we're going to save negative 500,000 Rand. So that's the one aspect. Now we have to deal with whatever else is in there. Let's have a look. So they say on 1 January 2017, Satoshi acquired an investment in Reddit bonds at a fair value of 3 million. No transaction costs were paid. The bonds pay coupon interest of 400,000 Rand on 31 December of each year and will be redeemed on 31 December 2017. So we acquired it in the current financial year. So the present value at the beginning of the year is the fair value of 3 million Rand. Okay, so that just take note of that. So we remember Satoshi holds this and is mandatorily classified at fair value through OCI. So there's two parts of this transaction. It is the amortized cost part, which deals with the interest income. The interest income is recognized in profit or loss. The second part is the fair value gain or loss. The fair value gain or loss, that part of the transaction impacts OCI. We are not interested in OCI. As a result, we're only going to focus on the P&L section of this question. Okay. So therefore, remember, with a financial asset that is mandatorily classified at fair value through OCI, just quickly, by the way, you will have two parts of the transaction. Okay, so the one part of the transaction, it looks like this. So we will have debit bank, which will be SFP, and it will be the bank amount that you receive, the coupon payment. This will be the coupon payment, you debit it. Then we will have credit interest income. Interest income will be credited over there. This will be P&L. Remember, the credit to interest income will be the present value at the beginning of the year. So in this case, fair value or your amortized cost amount, but it's at initial recognition, it is fair value. So it is the present value multiplied by the effective interest rate multiplied by time. In this case, it's 12 over 12. This is a full financial year. The balancing figure will go against financial asset. This financial asset is mandatorily classified at fair value through OCI. Okay, so fair value through OCI. That's the first part of the transaction. So this could either be a debit or a credit, depending what will balance the equation, what will balance the journal. The second journal entry will either be a debit or credit to financial asset. And the other part would be fair value gain or loss, depending whether it's a debit or credit. And that fair value gain or loss does not go through profit or loss. It goes through OCI. So the way you will get it, the way you get this number, so the way you're going to get that number is as follows. The way you're going to get it is as follows. It is going to be fair value of financial asset less financial asset amortized cost. So whatever the amortized cost amount is, you compare the financial asset at fair value to the amortized cost amount. So remember, the financial asset, the fair value amount was given to us as 2.5. So you would say 2.5. You compare it to the financial asset at amortized cost, and that difference, this difference would be your fair value gain or loss. Okay, so just take note of that. So this difference will be your fair value gain or loss. So that is how you will deal with this journal entry. So what are we interested in? We are interested in that line item because it is that line item that is going to impact profit or loss. So I'm just going to highlight this in orange because this is just by the way. That is just by the way, it's not part of the question. So to get working for, so to actually get working for, remember, how do we calculate interest? Interest equals present value multiplied by I multiplied by time. So therefore, interest is present value I and time. Time is how long in the year. So it is 12 divided by 12, which is the full financial year, 1 January 2017 to 31 December 2017. We don't have I, so we're going to have to work out I. Okay, so we're going to have to work out I. The present value is the present value at the beginning of the financial year. It is your amortized cost amount. But remember, we acquired this investment on 1 January 2017, which is the beginning of the current financial year. That is initial measurement. Initial measurement is your fair value, which is 3 million. So just take note of that. Now for working 5, we will work out the effective interest rate, which is I. In order to get I, we need PV, we need FV, we need PMT, we need N, and that's all. Okay, so the present value is the 3 million, which is your fair value. Future value is the lump sum payment at the end of the period. Future value is a lump sum payment at the end of the period. Remember they said the item is going to be redeemed at face value at 2.5 million. They gave the payment is your coupon payment. The coupon payment they told us is 400,000 Rand. Remember, PV and FV must be in the opposite direction. I always just keep PV negative. N is the number of periods. We took this out on 1 January 2017. We're going to redeem it on 31 December 2019. So therefore, year 1 is 2017, 2018, 2019. So it is 3 periods. So now we can work out, now we will be able to work out the effective interest rate. So In Excel, it is a rate. So they want N, they want PMT, they want PV, and they want FV. Excel always just want a guess. So I'm just going to make any guess. I'm going to make it 10%. And okay, we got 10%. Okay, you can make any guess. Let me just change the guess. So let me just change the guess. Let's just make it 8%. You make anything. Okay. Oh, we didn't put in type. Type, it is beginning of the period is 0. Okay. Okay, let me just change this. Let's make it a guess. So we make the guess 10%. So therefore we have 8%. Okay, so that is our rate. So our I is going to be what we getting the effective interest rate. Remember, you in a financial instruments question, if you didn't work out an effective interest rate, you must just question yourself whether you read the question properly. The chance of you having to calculate the effective interest rate is like close to 100%. So interest is present value times I times time. So therefore, our interest earned for the year is going to be 246. Interest income increases profit or loss. So therefore, we will add it. So here we're going to go interest income. And it's going to equal C77, I think. Yep. So that is our profit or loss for the year. So as you can see, still financial instruments, but the way they ask the question, very different. Is this right? 32, so 32,560. 32,560. So that is our adjusted profit before, what you call it, okay. So that is how we tackle this part of the question. So that's it from my side. Do you guys have any questions?
No questions.
No questions.
Okay, Fakir, Irfan, Ryan, Valis.
No questions.
You can see the way they deal with this is quite is the same. It is the same. How can I say now? It is the same. Same what? It's the same principles and stuff. However, the way they test the question is very, very different. So you must be able to think across everything. Keep in mind, what is this course? It is financial reporting, ultimately preparing financial statements. You need to know how it looks in financial statements. You need to know how it looks in disclosure. And the best way to know how to do all of those type of things is to know the journal entries. If you know the journal entries, you must ultimately know how it will impact the income statement, balance sheet, and all of those type of stuff. Okay. But that's it from my side. We will continue tomorrow with the rest of the question. We will do part 2 in the first hour, and then we will deal with share-based payments in the second hour. Okay. So for the FAC1 students, you don't have to deal with financial with share-based payments. That's what we're going to do, share-based payments in the second half of the class. But we'll do part 2, which is a very important part on financial instruments, a discussion question that you will most likely need to know. Okay, so I'll see you guys tomorrow, 7:30, and then, yeah, so then we'll complete the question. Okay. Okay, thanks guys, bye-bye.